Welcome to the Finance Podcast. The topic of this episode, Emerging Markets, Comeback or Structural Risk, by Shamila Khan, Alex Smith, Lisa Turk and Eric Lloyd, moderated by Adrian Pass.
Excellent. Hello. Thank you for attending our session. Thank you for coming here. So just before in this very room, I don't know how many of you were here, there was a very hot topic of AI. And right now we're kicking off with another hot topic of EM. Those of you who follow financial markets, I think it would be fair to say that in the past 3, 4, maybe even 5 years, emerging markets were a little bit unloved. I think both on equities and on fixed income side. Me personally, I meet with clients and I saw that, let's say, part of the interest until recently was intellectual. It was an interesting discussion, but somehow it rarely made it to the allocation grid or to further stages of discussion. And then we've witnessed, mostly last year, a turnaround, and I think it was a turnaround across equities, fixed income, forex. Some people could argue that the developed markets, mostly US, that were seen as the gold standard, and when you're going from DM into EM, you are adding risks. Now some people think maybe I should diversify away from those core DM markets because actually I'm actually reducing some of those risks. So just a question mark hypothesis. On behalf of CFA Society Switzerland, we're very happy to bring to you today a panel discussion with experts across industry and across those asset allocation. So we have Shamila Khan from UBS. We have Lisa Turk from Edmond de Rothschild. Alex Smith from Aberdeen, and Eric from LNG. Eric Lutz, sorry. So maybe just to kick off the discussion, to set the stage, what has changed in the past year, let's say since 2024, in the markets, in your understanding? What has triggered this interest? How has the macro, I would venture to say, improved, maybe starting with a macro view from you, Eric?
Yeah, I think, the emerging markets had a difficult few years, I think mostly because the dollar was very strong. And I think once that conviction set in that the dollar is maybe not only going up, but there is actually a chance that it might go down, I think that's when emerging markets start to become more popular. I think the other one is, of course, the exposure to US dollar of international investors, the exposure to the S&P, the huge concentration in tech. I think all that made people nervous, and I think emerging markets are a nice way to diversify out of that. That would be my view.
Mm. Yeah. And looking at fixed income, Shamila, Lisa, what have you seen in the markets? What were the reasons for some of those changes?
Yeah, so there's been a tremendous fundamental improvement in emerging market countries, but I think it is important to understand that on the hard currency debt side, sovereigns and corporates, the performance has been strong for 3 years. It really only happened that last year, and sometimes investors need a psychological trigger. The psychological trigger here was the dollar weakening, which obviously impacted local currency debt's performance, which has been a very poor performer for a long period of time. But the hard currency debt, actually over the last 20 years, has performed very well versus similarly rated US corporates, for example, or global developed market corporates. So I would say it's almost like a psychological trigger last year, which led to money coming not only through crossover investors into emerging market debt, but also directly into emerging market funds. But the fundamental drivers and the performance actually existed way before then. And I would also say that the technicals today in emerging market debt, and I've done this for 28 years, are the strongest I've ever seen them. As you correctly mentioned, emerging market has been unloved. Emerging market debt did much better than emerging market equities between 2022 and 2024, yet it had more outflows. So it had like 150 billion of outflows. So if investors want to go back to where they were in 2021, they have to add hundreds of billions of dollars of emerging market debt. But if they really want to diversify, which is everybody's intention, based on the client conversations we're having, they could be adding $500 billion or more in emerging market debt. So this is a very powerful technical, and at the same time, in hard currency debt, the net issuance has been mostly negative for the last few years. So you have tremendous supply coming in with very limited supply, demand coming in with very limited supply in the hard currency side. And that is something we've been highlighting is going to continue to drive the outperformance of emerging market assets.
Maybe one thing to add there, because I fully agree with what Shamila said, is that when you compare other fixed income classes, US high yield, European high yield, IG, whatever, every asset class has recovered its outflows that it had seen in 22 as of today, except emerging markets. So we are the last asset class where flows have a huge potential for increase. So I fully agree with Shamila when she says that this should be a huge driver, a huge technical driver for performance in the next few years, actually, for the asset class. Another element that is, I think, important is that more and more research shows that the distinction between EM and DM is becoming increasingly blurry as well. So there's more and more convergence in fiscal frameworks, in monetary policy transparency, in liquidity, etc., etc. So it's fostering a very positive case for emerging market assets because investors, it suggests that an increased exposure to EM assets overall can bring returns and a huge amount of diversification, obviously, as well.
Thank you very much. And Alex, on equity side, what are you seeing?
Yeah, great. I think that the case for equities is pretty simple right now. And as all these guys have highlighted, the macro picture looks a lot more stable. And for equities, that sets the table. But we eat earnings. And what we have now is an earnings growth premium in emerging markets. And that can pull capital into the equity market. So next year, consensus is, or this year, is for 18% earnings growth over 2026, alongside a 3% dividend yield. And MSCI EM is trading on 15 times forward earnings. So the picture for total returns for equity looks very strong again, having a 35% return. Last year, you're looking at a plus 20% return from dividends and earnings growth again this year if consensus comes through. So the picture for equities is looking good, and we think that can be delivered consistently. And that's important because of, as we're talking about this capital picture, all this money that could come into EM, if you get that growth premium, you get reflexivity, which is people see it works, they see the growth comes, and then it becomes a self-fulfilling prophecy. More investment, more earnings growth, more performance.
Thanks very much. And where would you be deploying capital right now in EM equities, moving on to convictions that we have?
I think one area that's really overlooked in EM has been the dividend story. So actually half of your returns in emerging markets for the last 20 years has come from just simply receiving dividends. And that ranks it right at the top in terms of a dividend market globally. And in our EM income strategy, that's driven 1/3 of the alpha. So there's certainly money to be made by looking at where you can get an income premium in EM. Industrials, particularly interesting at the moment. The EM industrials are good dividend payers. And because of what we've seen with tariffs, Chinese competition has been knocked out while demand is surging as Western economies try to reindustrialize and improve their resilience. And added to that, you've got this reform agenda. So the value up program in Korea is the most famous, and that's pushing more dividend payment. So the culture of paying dividends in EM is getting stronger, not weaker. So we think there's a long way to go in terms of the attractiveness of EM dividends.
Thanks very much. On fixed income, how do you see this developing? Between obviously you sit in different strategies, so that's also what makes it interesting. Between sovereign, corporate, high yield, and investment grade. What are your convictions also by countries?
Yeah, so I do have the luxury of doing everything. So I can sort of look across, the sovereign space, the corporate space, investment grade, and high yield. And it's been interesting that usually the corporate space is the most misunderstood. It's relatively newer in terms of large amount of issuance, and therefore you get these dislocations in the corporate space. But what we noted a few years ago is in the hard currency sovereign space, the market had completely mispriced many countries. And a very regular part of our process is doing fundamental stress testing. So in 2023, there were a number of countries trading like they were going to default. And we stress tested them and said they have no access to markets for the next couple of years. Can they still pay debt? And we realized that most of those countries, number one, can pay their debt even without access to markets. Secondly, there were a number of countries in emerging market that had defaulted and were emerging from restructuring. And this was a tremendous return opportunity that the market was missing. And it was really only due to this in-depth research that we highlighted this opportunity. And what we have seen, and we actually went public in 2023, which was a very controversial thing, and said there will be no defaults in EM sovereigns in 2024. There have been no defaults in 2024, there have been no defaults in 2025, there have been no defaults on 2026. The upgrade-downgrade ratio in EM hard currency sovereigns has been the best we've seen in 10 years. So there's really been this tremendous fundamental improvement that the market hasn't grasped because the media hasn't been talking about it until recently. And I was at the IMF meetings last year in October, and the IMF actually, as part of the World Economic Outlook, has written a whole chapter on emerging market resilience. And the general takeaway, as Lisa was saying, from that, the meetings in October, was the risk really isn't in emerging markets. The risk is in developed markets.
Thanks very much.
On the corporate side, one region that we like a lot and where we deploy capital currently is Latin America. So Latin America is more of a high-yield region, so coupons are high, carry is high, which is something nice to have currently. So you get well compensated, especially as fundamentals have improved massively over the last few years for companies. Companies have high cash levels, low debt levels, they have good strategic plans, they have improved their management drastically over the last few years. So it is a region that is very compelling. Two other supports for the regions are first the evolving political landscape in Latin America. As you probably know, there has been a broad shift towards the right in Latin America in recent quarters. I'm thinking about Argentina, Chile, Ecuador. And this is obviously linked with more market-friendly reforms, with more fiscal stability, etc., such that it is obviously supportive for Latin American corporate debt bonds as well. Now, there's other elections coming up this year. We expect, there's elections coming up in Brazil, in Colombia, in Ecuador. Here we don't have a particularly negative view, actually. We expect either status quo or a more positive outcome. Again, maybe more towards the right, which would be market friendly, which is why we do like the region overall as well currently. The other element is that Latin America is set to benefit from changing trade dynamics overall. It's true that Latin America has been signing in recent months trade agreements with China, with Europe. They are in talks with Canada, which is a strong political signal. So they are evolving in terms of trade. They are improving their trades and their partnerships with other countries, which is a great support, obviously, because corporates will benefit from these new trade flows with new countries. So high-yielding companies with supportive politics and supportive trade dynamics is our main take there.
Thanks very much. So we have heard so far a strong case on equity on fixed income side, but maybe to Eric, from a macro perspective, for an allocator, for even individual investor, where should EM sit in the allocation? What has changed? What is the diversification, let's say, value add of EM these days?
Yeah, I mean, as I said, I think, the US is quite expensive, the US market. You are very concentrated in tech. And here EM has several themes, which is nice diversification. Some of them already mentioned. You have some tech exposure with Korea and Taiwan, but you have many other stories. You have the commodity metals angle here, Chile, Peru, South Africa, they have very strong terms of trade at the moment. We heard in Latin America, we have the whole shift to the right, which, is I think, a very strong catalyst. In Europe, I think, in general, the outlook on Europe is way too negative, very much focused on the structural weakness of Europe. I think what people are underestimating is once the cyclical upswing takes hold, I think, sentiment will very much improve there. And with it, of course, the CE3 countries will also outperform there. So, and then I think growth will be fine, will be very, very good this year in emerging markets. The median inflation in emerging markets is below that of the US. 40% of emerging market central banks have cut rates in the last 3 months, and they will continue to do that. And the dollar is still very, very strong. The risks, I mean, it's very difficult to predict the dollar, but the risks are more to the downside than to the upside, which usually also helps growth. So I think, it's a little bit of a non-brainer to me, I would say, yeah.
And for, obviously, we are all trained to also be devil's advocates sometimes. We've seen that emerging markets had a couple of, let's say, false starts. Some people got burned in the preceding years. And it always feels like a safer allocation to the countries and companies that investors know already very well. What would be the downsides that you can see, the potential, let's say, down scenarios that you, quote unquote, fear or that you're on the lookout for in the coming year?
Yeah, obviously, I would say that, first of all, I would say, dollar weakness is not the core of our investment case in emerging markets. But, were the Fed to be more hawkish, were the dollar to strengthen from here, that would be a headwind, right? And what could trigger that? I mean, we know that, a lot of the tariffs in the US have been borne by US enterprises. It's not our base case, but it could be that eventually they pass those on to consumers. If the tariffs get refunded, that would be a fiscal stimulus. Those are all things that could keep inflation firmer than expected. The Fed would be cutting less than expected. And then, it looks increasingly likely that the US is going to attack Iran. If that turns out more messy than expected, that could have an impact on oil prices. I think those are kind of the two key risks that I see.
Understood. I think you mentioned something that is almost like a base case for most investment houses these days, which is further weakening of the dollar, which is a question mark if it will continue. So maybe we can also, if in your responses you can also comment on that. But going back to the, let's say, down scenarios or the risks you see on your end.
Yeah, sure. So, we by nature try to avoid consensus trades. And we are a little concerned that the short US dollars become a consensus trade. So we are not predicating our thesis in emerging market debt on a weaker dollar. Now, do I think in the next 3 to 5 years the dollar could weaken? Somewhat, yes. Do I think that in the next 3 to 5 years there can be periods of dollar strength? Yes. And the market isn't positioned for that. And so, we were actually discussing before, it is very important to have the right entry point in local currency debt if you want to make money. And also you want to be there when it's not a crowded position. However, on the hard currency debt side, what we have seen, as I mentioned, is an outperformance of hard currency debt, not only in the last 2-3 years, but if you look at it over a long time period, on 20 years. It has outperformed in a time period when dollar was appreciating, when US was exceptional, when rates have been rising, even if you incorporate those time periods. EM hard currency, sovereign and corporate debt have actually outperformed. Corporate debt has had the best risk-adjusted returns. So therefore, we think that that should be a structural part of investors' allocations. On the local currency debt side, it's very important to time that well. And right now, we are a bit concerned that there are a number of investors who actually do not follow emerging markets buying high carry EM local markets because they want to play the weaker dollar story. And the reality is what happens in those countries from a fundamental perspective will be a bigger driver of performance than just the weak dollar. So that's sort of how we are framing it. And from a downside perspective, I'm not as concerned about necessarily the dollar weakening, changing the fundamental view on emerging market, especially hard currency, sovereign and corporate debt. I'm more concerned about developed markets. I'm more concerned about the US equity market. I'm more concerned about US risks impacting risk markets in general. And so, but those are relatively easier to hedge. And so the real risk to me doesn't lie in emerging markets. It's more in what's happening in terms of overvaluation in developed markets. And when we are thinking about the downside, we're hedging those risks to protect our portfolio. But EM risk, we believe, particularly on the hard currency side, is going to be very well bid going forward.
Yeah, I tend to agree with what has been said, that external global shocks are the main risks. We don't have specific local red flags, I have to say. Obviously, there's some sectors to monitor. The chemical sector in EM, exactly as in DM, needs to be monitored. The oil and gas sector needs to be monitored as well. This is important for us. 11% of our investment universe are oil and gas companies. So most of them are big majors with low break-even prices that should not suffer if oil prices go back below $60. However, there's also smaller, medium-sized exploration companies that could be in a more challenging situation if Brent prices go back down. So this is something that we monitor very closely. Today, Brent prices are at 70, but we do expect oil prices to come to decrease again. That's quite a consensus view, but it's true that OPEC members have already almost announced that they will start their increases in supply again by April. So these are all things that we monitor very closely, and obviously we take investment decisions accordingly. On the commodity market, on metals prices, we do monitor them obviously as well. There could be a slight setback in in metals prices as well. However, we are not very worried actually about this potential slowdown there unless it goes below 2022 levels. But since 2022, we are really in a range that has been very comfortable for companies in this segment, in this metals and mining segment. Prices will probably stay high in this. Metal prices will probably stay high because there's a structural deficit in production simply for several key metals, such that, because of AI, because of the energy transition, because of the defense spending, etc., etc. So we don't see this risk as our main risk, but obviously we monitor metal prices as well because it has a big impact on our investment universe as well.
Thank you very much. Alex, on your end?
So for equity markets, I think we see this slightly differently to everyone else. What we see as the main risk for EM is probably the main risk for all equity markets, and that is the point when investors start to question where are the returns coming from all these investments in data centers by the US hyperscalers? 620 billion projected in capex this year by the 4 hyperscalers, and these companies are a quarter of the S&P, and they've delivered 40% of the gains since 2023. Now, how does that impact EM? Well, of course, EM hardware has been off to the races. Taiwan, Korea, these names have done incredibly well. So if that capex is to slow, it's going to be really bad for sentiment, for equity markets globally, and it is going to impact the share prices of TSMC, of Hynix, of Samsung, etc. So that's the big risk. It's the big risk for the US, and it will bleed over to EM for sure. Now, we do monitor this risk, of course, and we did an exercise earlier this year looking at the exposure of the Taiwanese and Korean names to US AI-related spending. And what you see is a much more diversified revenue base. For sure, the growth of that spending is embedded in share prices, but the actual fundamentals are diversified. So in Taiwan, we estimate on a market cap weighted basis, 20 to 30% of revenues coming from US hyperscalers. For tech suppliers, in Korea, we think it's about 10 to 20% coming from this AI boom. So the businesses themselves, where EM is most exposed to that major AI market risk, are more diversified than that. And that should create a buying opportunity. When we see this, when we see investors start to question this and this drawdown potentially plays out, that's a great chance to add to emerging market equities because they'll be caught in that. But the fundamental diversification should help a faster recovery. You've also got India in there, of course, which is known as at the moment as the AI hedge, domestic-driven market, lots of IT service companies. So you've got much more diversified offering in EM, but you do have exposure to that risk.
Thanks very much. Listening to this conversation, I would maybe ask the audience to reflect 5 seconds. What is one word that we have heard very little or less frequently than I actually personally expected, which is China? Because if you ask me, typically that's EM. There is a direct connection to China, and that triggers various reactions in investors between the weakness of Chinese consumer, between obviously the big elephant in the room, which is we can call it geopolitics or tariffs or what else. Do you have any particular comments on China, any particular ways how you maybe changed your view in recent months, why you're let's say bullish or bearish on that exposure?
No, sure. And when I said we don't like consensus bet, I really meant it, because when everybody liked China, I didn't like China. And now when everybody didn't like China, I said this is really a good investment. And that has borne out, right? Chinese asset prices have done actually very well. So even though the rhetoric and the growth numbers and consumption is, comes out sometimes not as one would expect, the reality is so much negative news was already priced into Chinese assets, that Chinese assets have been some of the top performers. Chinese high yield credit have actually been one of the top performers in EM corporates and EM hard currency debt. So that is important, is to sort of strip out what is happening in terms of headlines, but really understanding the fundamental improvement. So what is happening in China? First of all, since the end of 2023, pretty much every month or every other month, there is incremental stimulus. And everybody keeps waiting for this fiscal bazooka, and I said it's never going to happen because they don't want, A, to waste stimulus, and B, they don't need to do a fiscal bazooka. But this incremental stimulus is going to add up to normalized growth in China, and that is what's happening, and been a big driver of performance as well. Secondly, the housing sector there is also showing signs of stabilization, where nobody really noticed last year, but there was a big overhang in the housing market with respect to unfinished inventory, because all these developers had defaulted and they couldn't finish it, which the government took care of. And secondary sales have started to pick up, prices have started to pick up in top tier cities for housing. And that's extremely important because as a Chinese consumer, you're not going to consume until you feel housing prices have stabilized. So these are all things that are pointing in the right direction. And we do think that this continued outperformance of Chinese high yield credit can continue. This is again very out of consensus because now no one likes it. And when there were much higher prices, everybody liked it. But there is this dynamic happening, which is very important to monitor and is, again, a testament of how there can always be alpha opportunities in EM if you do the complex work.
Yeah, I would agree with this. We also describe the Chinese economy as a glass half full rather than a glass half empty. And the key reason is, I think, if you have seen a correction over 5 to 6 years, which we have seen in China, the risks are just very asymmetric. It's much more likely to rebound than to contract further. And you mentioned, I would say it's probably still contracting in real terms, but the rate of contraction is getting smaller and smaller and very, very close there to the bottom. And in equity earnings already, I would say we have bottomed. And so, and then, of course, there's a lot of focus on weak demand. But, I mean, there are incredible technological breakthroughs happening. The manufacturing prowess is mind-boggling. So I think, this is surprises there are much more likely to be on the upside than the downside would be our take.
And if I may add to that, right, this is actually very good for the world if the US is growing and China is slowing down. And as the US, because the fiscal stimulus is just unsustainable, slows in the coming years and China starts to stabilize, you don't want both countries to grow fast at the same time. You don't want them to slow at the same time. So this actually is very good for global growth.
I agree on from an equity point of view. We've been pleased to see China continue to export successfully, and that's partly due to all the technological leaps they've made over the last 5 years. We're looking at $1 trillion trade surplus for China last year, which is absolutely huge, and it shows how ineffective the tariff program has been. Exports have continued to surge for China, but that story, of course, has its limits, and we've seen the latest 5-year plan with a focus on consumption. And we actually think this is pretty meaningful. Okay, in 2020, when they released a 5-year plan saying we're going to lead in robotics, renewable energy, AI, etc., collective shrug. Today, I would say China is close to leading in all of those things. It's now the largest auto exporter in the world. So there has been basically a fourth industrial revolution in China over the last 5 years, and the plan now is to boost consumption. And that will have real impacts on how policy is made and what things are done. And that's the missing piece that can drive earnings, domestic growth, and an upcycle. Part of that will also be the equity market. They can't allow people to reinvest, to go through another property cycle. It creates social issues. It's inefficient. You get overbuilding. The equity market's a much better way to store wealth. So they bring that into the mix. So for an equity investor, the setup looks really strong for China for the next 5 years or so.
And maybe a connected question, that will be my last one, and then we can open so we can prepare your questions. Obviously, there was the ruling from Supreme Court in the US on the invalidating, let's see how it develops, of the, let's say, targeted and customized levels of tariffs, but by President Trump. Before that, there was a bit of talk about some countries, especially in Southeast Asia, being singled out. Vietnam, where there are high tariffs. Now there is a lot of, let's say, positive talk that I believe Brazil is meant to be the largest beneficiary of this, let's say, blanket unified tariff rate. If you have convictions, please share. But also, how do you cope with that as investment managers, right? Because you wake up to news that completely change your investment case overnight.
Yeah, and we really like volatility, actually, because that's how we make money. So all of that we try to prepare for by constantly doing the analysis before it happens to really check where the vulnerability is on the trade side. And the reality is Asia looks like a target, but Asia is most equipped to deal with this kind of pressure because they have tremendous room for fiscal stimulus. They're very strong externally. They also have room on monetary policy. So if the trade war were to happen the way it was originally designed in Liberation Day, Asia would have been able to withstand it. And you've seen really high tariff rates, China, India, Korea. They've really not been impacted from a growth perspective. I think this is, it's a complex topic, and I think the market's focusing on things that are probably not the real risks. First of all, Brazil is likely to be a target because the Section 301 has already been completed on countries like Brazil. So they can actually increase tariffs on Brazil whenever they want without doing extra work. Number two, I think the market is underestimating the risk on Mexico. Trump has actually, the US administration has floated the idea of possibly getting out of USMCA, and there's been no reaction in the market. So I actually think there's probably a little bit more risk on the Latin American side over there, whereas Asia, is always important because that's where the large trade differences are, but they have a lot of room in terms of policies to be able to manage that.
Yeah, maybe one thing to add on Brazil. It's true that, last year they were a huge target. Obviously, they had 50% of tariffs. We're going to see how this evolves, right? But I think one important thing to keep in mind is that actually most corporates, at least in our investment universe, don't have so much exposure to the US. So there's a handful only of companies that export more than 10% to the US. So the reaction of our corporates was actually relatively muted. They said, we can cope this. Plus, there were tons of exemptions. So every sector, in the end, got exempted. There were 600 products that were exempted from the 50% tariffs, such that in the end, it was, the true impact was very, very little. So I agree with Shamila when she says that, we need to look into more details how these tariffs are being implemented. Mexico could, for example, be more more in danger than Brazil, despite the different taxes that have been announced. Now, what I think is also important is that it just creates so much uncertainty overall, and it could actually play out to be a positive catalyst for most countries, especially in LATAM, but also in Asia, as you said, because it's just the entire trade dynamics that is completely changing. So there's trade deals that are being struck between Brazil and China, between Brazil and India, between Mercosur and Europe. These are all very important drivers for the companies. And South-South agreements are increasing as well. So it's important to note that these changes are happening quickly, and we already see the impacts on the corporates. So what we did, for example, was to actually increase, for example, beef and poultry producers in Brazil and in Argentina, because they have been increasing their trade deals with China. So they are benefiting from these new trade deals, and should be winners in the end from these trade changes and developments. So I think, when you look into more details, there are clearly nice stories that can come out of these deals.
Yeah, from picking up on your point there, Lisa, about beef, thinking about tariffs, it's not quite a nothing burger, but I think Trump, he came to office a second time and he thought he had a big whopper all juiced up on American hormones, and he's bitten into it, and it's a vegan burger. It's not the weapon he thought it was, right? And I would say, coming back to China, why? Leverage, right? The headlines, all this stuff, the corporates get round it, laws come through, it's all this complicated mess. It's not really impacting markets. Why? He doesn't have any leverage. The Chinese got ready for this, okay? Between his first presidency and now, they have adapted. They've secured that rare earth, the rare earth refining capacity gives them a monopoly. They've massively increased their renewable energy. He can't squeeze them in the same way, so they're meeting as equals now. And that is why I think a big reason why the Chinese trade surplus has not come down and has in fact absolutely surged since Liberation Day. Add to that just a complete lack of industrial capacity in the US in so many areas. They really are struggling to kind of constrain and rebalance their trade.
Thanks very much. Maybe opening to you. Let's take questions. Yes, please. Let's just wait 1 second for the. Yeah.
It's okay.
There is the possibility to play the emerging market ex-China or with China. Would you under or over expose China in your portfolio? What is your opinion? Thank you.
Is that for me, for the equity?
Yeah.
Okay. I can go for, I mean, in equities at the moment, we'd be underweight China, but that's about 2% if you include Hong Kong. And in terms of a risk driver in equities, China tends to drive a big portion of your risk because it's either going up all the way or down all the way. So we keep the overall risk level around benchmark level because it is difficult to call the changes. Of course, we include China. Yeah. Listen, MSCI gets a bad rep, but probably the weight of China's about right? There's problems with the equity markets, but there's also the huge GDP and on the other side, and it's important. So a 30% weight in our portfolios, we think is around that level is about okay, 25 to 30%.
On the debt level, on the corporate side, we tend to focus more on higher yielding corporates. So China is not so much in our scope, I have to say, because China is a very much investment grade country and has relatively, has corporates that have relatively strong balance sheets. So it's not so much in our scope. Now, for an investment grade strategy, it does make sense to have exposure to China. It's very, there's very low volatility in IG. I would not completely exclude it, no. Yeah. But maybe it's all, you have to look at relative value and do specific, work.
Yeah, so I think it's important to understand the difference between EM debt indices and EM equity indices. And actually, I will go into that in my presentation. That's after the next presentation, in case anybody's interested. It's just a little plug there. But in the debt indices, China's constrained. It's not big, like the equity index. So that's important to understand that it's not a big part of the universe, number one. So there's no need to constrain it. And secondly, as Lisa said, investment grade, less value, but high yield companies still have a lot of value. And those, are really worth looking at and have been overweights for us.
Question on geopolitics and the impact on emerging markets. The US is about to obliterate Iran, bombard the whole Middle East, set the whole Middle East on fire. It's 40% of global's oil production. How do you think that might impact emerging markets? This is first question. And now we're seeing new alliances, Pakistan, Saudi Arabia, Turkey. Turkey is next after Iran, as the Israelis announced a few days ago. And India, with Brazil, with their alliance on rare earth metals.
Yeah. First of all, I don't think we can assume anything in terms of what the US administration is going to do. This is an election year, and the last thing they want is very high oil prices. First, I think we need to understand, just like when the trade war happened, I think it was very important to understand that, as was mentioned earlier, it was a negotiating tool. And ultimately, tariffs are not paid by the exporters. It's being paid by US consumers and US companies. And that's why they're kept coming down. And there were all these exclusions that Lisa referred to because it was not favorable to US companies and US consumers. Similarly, I think any negotiation strategy always feels like it's going to fall apart until it actually happens. So I think we have to wait and see what's going to happen. Well, they're meeting exactly, not so far away from here. And this could be a process of negotiation that continues for some time. But nonetheless, I think the other thing to understand is, hypothetically, if something like that happens, this is something that we have always, we have, and as Lisa said, we're not only stress testing emerging markets for high oil prices, we're also stress testing it for low oil prices. Because
how would you stress test if this happens?
If this happens, first of all, oil exporting countries also benefit. Half of the EM debt index is oil exporters, right? So you have to really understand from a bottoms-up perspective. But as Lisa said, there's OPEC that has also the ability to mitigate any increase in oil prices. We are actually more concerned about lower oil prices. We do think that ultimately there will be some negotiated outcome, and therefore your oil prices are likely to go lower. The downside and being able to manage that risk is more important because very little from a direct impact will be negative for EM debt indices if oil prices go higher, except the general risk off, right? Because it'll be, obviously, if there is an elevation in a conflict that's always leads to a general risk off, I would be more concerned about equity prices.
very big picture on increased geopolitical volatility, I mean, we generally see it as noise and opportunities to buy. There is a lot of talk about, increased geopolitical volatility, but that's kind of the state of the world, how it usually is. What was exceptional were the last 35 years, because we had a unipolar world, which felt like almost a nation state, right, with one policeman. Now we are back in a multipolar world with China's arrival. Who is Russia going to align with? But this is how the world always was, right? I mean, if you're a little bit older like me, you remember that world.
I'm not that young.
Anyway.
Alex, what do you think about India, Brazil?
In terms of the current
Alliance, rare earth metals, equity in those countries?
So, I mean, from an Indian point of view, we always have the issue of India being expensive, right? You have the best demographic story in the world, 6% GDP growth going on as far as the eye can see, pretty well managed finances, but you've got to pay up for that exposure. So it is an underweight in portfolios, but we've seen valuations come off, pretty healthy correction last year, and we're still getting that feed through into earnings growth. So the series of Modi reforms pre-2020 have seen equity earnings growth go from below 10 to well into mid-teens pretty consistently. So that 6% GDP growth is feeding through to earnings growth quite nicely. So where we can find opportunities in India, the question is always valuation. So that's how we see India. We also, as I mentioned, we think it's the AI hedge. This growth is domestically driven, so it should be very resilient. It is exposed to higher oil. That is one of the risks for India. But we're not too worried about that for the reasons I think just described. And then on Brazil, the market, the big question is fiscal. What will they do? I'm not going to pretend to be as much of an expert as the rest of the panel. We keep that about a neutral weight. There's some great companies in Brazil, but we're always cautious about what will happen with the currency. Potential for a huge cutting cycle, highest real rates in the world. That would be a great scenario for equity. So we're watching the election quite closely, and then what Lula does.
Excellent. I just realized we're a little bit over time, so we should be closing. If you have a question, can you make it please short and dark? Yeah.
What's the impact of the BRICS states in the future? What's the impact of BRICS states in the future and its own smart way? Thanks.
Okay, my quick answer to that is I think we should be careful. It's not, there have been these amazing projections, what's going to happen to them. Many of them were based really on this period, 2000 to 2008, when we had a massive commodity cycle. If you take a longer horizon, then there is convergence of emerging markets with advanced economies, but it's much slower. So I would not overplay that angle.
Excellent. On that note, thank you very much for attending. Thank you to our panelists, and invest in emerging markets.
Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory. New episodes are released every Tuesday and Thursday.